Thank you, Mr. Chairman. And Chairman Bernanke, you've previously indicated that the Fed wants to see substantial improvement in the labor market before cutting off QE. And in your June press conference, you noted that substantial is in the eye of the beholder. If I understood you today, you indicated that if all goes as expected, we could expect to see this wound down completely by mid-year next year. Is that correct?
If all goes as expected, yes.
And I guess the flip side of that is you said if all does not go as expected, we could see QE continue for the indefinite future.
I suspect that at some point that the economy will reach that substantial improvement in the outlook, given the way we've seen progress to this point. Exactly whether it's a little bit later or a little bit earlier, that remains to be seen.
I guess my question is, I assume you would agree that there is risk in continuing QE indefinitely. Would you agree with that?
Yes, there are costs and risks to QE, and we're watching those carefully. We've said in our statement that one of the considerations that we're looking at every meeting is the efficiency and costs of this program, and we do a benefit cost analysis as we discuss the benefits and of additional purchases.
Well, given the notion that substantial is really in the eye of the beholder, I don't think it's very easy for the markets to understand exactly how and when we are going to see the winding down occur. And to me, it appears that possibly communicating more specific targets rather than thresholds would help to reduce that risk. Do you agree, or do you think it's just not possible to get more specific?
Well, this is an issue that the committee will continue to discuss. I would say first that we have given some fairly specific qualitative guidance about what we're looking for, and I did say that unemployment in the general vicinity of 7%, with inflation moving back towards this 2% objective, was indicative of the kind of progress that we were trying to achieve. The thresholds are tied to rate increases, and there, while reaching that threshold doesn't necessarily mean that we'll raise rates, we are quite confident that we will not raise rates before we get to those points. In that sense, we're providing a reassurance to the public and to the markets.
Thank you. And with regard to winding down the Fed's balance sheet, you and others have indicated a willingness to keep the Fed's QE securities on the balance sheet, rolling over maturing securities and keeping them out of the market. Governor Tarullo said on Monday that no one is talking about unwinding or selling the securities we've been buying, which would mean then that the Fed's balance sheet could be over $3 trillion for some time. Correct?
Well, not necessarily, because of course these ultimately we will stop rolling over and reinvesting the securities, and then they'll begin to run off, and then the balance sheet will start to come down. We have done a lot of scenario analysis, of course, and allowing the securities to run off at a certain point when the economy is strong enough does not delay normalization by very much.
But you're not expecting the winding down of the balance sheet at any time soon. Is that correct?
Certainly not until we get to the rate increase part of the three-part sequence that I described to you, and there again it would be not. We are not planning at this point to sell any MBS. What we would be doing would be allowing, at some point, we would be allowing the maturing securities just to run off and not replacing them.
But as long as you continue to hold and not wind down the balance sheet, doesn't this lead to credit mispricing and increased investor risk undertaking?
I don't think so, particularly when we're winding down. I don't see that there's any real difference between, for example, our holding mortgage-backed securities, which is intended to strengthen the housing market, and usual monetary policy, which lowers long-term interest rates through short-term rate cuts, which is also intended to strengthen the housing market. The housing market is always an important channel of monetary policy, and so I don't really see that there's any significant misallocation going on there.
All right, thank you.